Now, welcome to this presentation on implied volatility of options. I'm Aninda Datta, the presenter. Here we'll cover the following aspects of implied volatility. What is implied volatility? Significance of implied volatility in determining the option value. Structure of implied volatility, that is changes in IV strike price and term structure. Implied volatility as guide for option trading. So let's get started. The fundamental question is, what is implied volatility in mathematical terms? The formula gives implied volatility given by Black-Scholes method, the most widespread method to value options. Here S is the spot price, K is the strike price, R is the risk-free rate of return, sigma the implied volatility, and T is the time to expiry. D2 is very important variable whose formula is given, which is adjusted negative Z score of the strike price if spot price is the mean of a normal distribution. As ND2 is the cumulative probability distribution of D2, so it is the probability of a call option expiring in money. Similarly, 1 minus D2 is the probability of a put option expiring in money. The sigma given in the D2 formula indicates the annualized standard deviation of the return of the asset. As D2 is the adjusted negative Z score of K, the strike price, with S as a mean, implied volatility affects the expected mean return of the asset. Now, what is the significance of implied volatility? Implied volatility indicates how expensive an option is for a given set of other variables like strike price, time to expiry, and risk-free rate of return. The implied volatility of an option is driven the most by historical realized volatility of the underlying asset. However, the extent of positive correlation between the two variables varies with asset and market condition. The Black-Scholes method assumes volatility of the asset to remain constant during the tenure of the option, but volatility keeps changing in real life. Comparison of implied volatility with historical implied volatility of the option on the same asset provides guidance on expensiveness of the option. Many websites disclose percentile and rank of implied volatility of options of various assets compared to the historical implied volatility figures. As BSM assumes normal distribution of return of an asset, so implied volatility of all options of an asset across different strike prices having the same time to expiry should be the same if the returns are normally distributed in real life as shown in the adjacent graph. However, as real life returns are not normally distributed and return expectations are asymmetric, so options implied volatility have a volatility skew. The below is the option chain for Nifty options on 27th March for 25th April expiry of options. The implied volatilities across different strike prices are different. As could be seen from the chart that both call and put options have different implied volatilities for different strike prices. Out of money and in money options have generally higher implied volatilities than the at the money options. Now let's cover how volatility skew shapes up for various assets and markets. The implied volatility graphs of call and put options of Nifty options with 1 month expiry are given in the chart. The implied volatility graphs of both call and put options are downward sloping, indicating an expected downward move in the market or a flat market. As during a crisis situation, people sell equity and move to safer assets, so generally equity options have left skew as investors pay a premium for downward protection. However, during crisis situation, prices of some essential commodities move up. So commodity options have a right skew as investors pay a premium for upward protection, as indicated in the second graph for crude oil. The generally expected market direction also determines the direction and extent of the volatility skew. Generally, out of money options have higher implied volatility for all assets, as in real life the outlier price movements are higher than predictions by the normal distribution curve. So option sellers demand high premium for out of put options. For out of money options. Now, when is a volatility skew called volatility smile? When IV curve plotted against strike prices in is perfectly symmetric smile shape as depicted in the graph, the IV graph is called the volatility smile. A symmetric volatility smile happens when return expectations from the underlying asset is symmetric. This happens mainly in case of options on fixed income securities. The second graph shows left volatility skew as investors pay downward protection premium. This happens in case of equity options where downside price movement is sharper on happening of adverse events. The third graph shows the right volatility skew as investors pay upward protection premium. This happens in case of essential commodities like crude oil, where upside movement is sharper on happening of uncertain events. Now, what is volatility term structure? Conceptually, it is the same as interest rate term structure. The term structure of a volatility is the curve depicting the different implied volatilities of options with the same strike price but having different maturities. It reflects the expectations about future volatility of the underlying asset. If the volatility of the underlying asset is expected to increase in future, then the term structure is upward sloping as shown in the first graph. This happens in case of key events in future like options on currency and fixed income securities before a central bank meeting. The downward sloping term structure is depicted in the second graph and generally happens in some cases like commodities after expiry of high consumption season. This also happens in case of seasonal commodities immediately after expiration of the production season. Now, what is volatility surface? Volatility surface is a 3D visualization that plots volatility smile and term structure of a volatility in a consolidated three-dimensional surface on a given underlying asset. A volatility surface is depicted in the adjacent graph. This is a volatility surface of Nifty options presented in a tabular form as could be seen from the graph. The term structure is downward sloping for all strike prices, indicating that a flat to bearish market sentiment. As the longer term IV is calculated by multiplying the IV of shorter period with square root of T, so option buyers pay generally lower IV in case of a flat market. Thus, they keep the premium same. That is, the option premiums for a specific strike price remains more or less same over a reasonable term structure. This slide is more of an academic interest, as in real life two variations are tracked separately. Now, how to strategize for option trade based on volatility. Tracking IV is very essential for traders as it gives a broad direction of the market. Shape of volatility, skew and smile help in formulating the various option trading strategies like trading in spread, straddle, strangle, etc. The objective is to sell options at high IV and buy options at low IV so that the combination achieves the desired delta and premium income. Like in a scenario of sharp upward sloping volatility smile, short strangle is recommended. Whereas in a range bound market with a flattish volatility skew, a short straddle could be tried out. However, complete strategy based on volatility skew curve shape is a large area in itself and would be topic of some other video. Comparison of IV with a historical IV leads to better decisions to long, short and option. Tracking of IV of assets also provides guidance towards directional trade on the asset. So that's all for this video. Thanks for watching.